Let us look into a few more problems with regards to admission of a partner. Look at this problem here. Following is the balance sheet of A and B, who share profits and losses as 3:2 respectively, as on 31st of December 2014. So you have the old balance sheet there. You have liabilities and assets. On the liabilities side, you have capitals for A and B. Then you have an amount for reserve, 10,000, and creditors, 25,000. And then you have assets, land and building, plant and machinery, stock, debtors, 20,000, less provision for doubtful debts of rupees 1,000. And then you have balance of cash and balance of bank as well. And in the additional information, it was given to us on 1st of January 2015, C joins the firm and brings in the following assets. He has stock, rupees 21,000, investments, rupees 12,000, cash, rupees 15,000, and debtors, rupees 10,000. Following were agreed upon. Number 1, the new profit sharing ratio among A, B, and C will be equal. Number 2, the capitals of the partners should also be equal, taking C's capital as base. Number 3, the reserve of the new firm will be rupees 15,000. Number 4, provision for doubtful debts is to be created at 10% on total debtors. And number 5, an investment provision of rupees 2,000 is to be created. Then they asked us to prepare the balance sheet of the new firm. So in this particular question, you have two partners, A and B, sharing as 3:2. And they have introduced a new partner, partner C, who is going to be bringing in all of these different assets. Now, additionally, it is given that the new profit sharing ratio is going to be equal, and the capitals of your partners will also be equal, but we have to take C's capital as base. C's capital as base means whatever balance is there with regards to C's capital will also be the balance or the capital for your other partners. And reserve of the new firm will be 15,000. The old firm had a reserve of rupees 10,000. So that original reserve should be written off, and then you should write up this new reserve of rupees 15,000. And it was given provision for doubtful debts is to be created at 10% on total debtors, and also creation of an investment provision of rupees 2,000. So let's start by preparing a few working notes before we move on finally to the calculation of the balance sheet. Right, so I have prepared my first working note. My working note was going to be my partner's capital account. And I've already prepared the tabular format for this, my particulars, and then debit, credit, and the names of my three partners. So I'm not preparing the revaluation account for this these questions. So let's start with the working note. And in the working note, as I've said earlier, I'm starting with the partner's capital accounts. So for the partner's capital accounts, whenever you're opening the partner's capital account or any other ledger account for that matter, firstly, we should record the opening balances. Okay, so the opening balance for this question, capital for A, 35,000, capital for B, 30,000. These are my opening balances for my partners. So I'll write it down by balance brought down. For A, as mentioned earlier, it is rupees 35,000. Okay, rupees 35,000. Then for B, it is rupees 30,000. C is the new partner, so it is nil. And then additionally, let's concentrate again on the balance sheet and see what else is there and compare it also with the additional information. So on the 1st of January 2015, C joins the firm and brings in the following assets. So he has brought in assets in the form of stock. In the form of stock. So let's write that down by stock account. By stock account, and C is the one who is bringing in it, and he brought in stock rupees 21,000. And the next asset he brought in are investments. So by investments account, brought in again by C, he brought in investments rupees 12,000. And then further, he also brought cash to the extent of 15,000. So you can write that also down by cash account. By cash account, rupees 15,000. 10,000, and he also brought debtors. So by debtors account rupees 10,000. So we have recorded all of the new assets that have been brought in by your new partner, by partner C. And now let's move back to the question. The new profit sharing ratio among A, B, and C will be equal. Okay. The capitals of the partners should be equal. Okay, that is also for later. And then the reserve of the new firm will be rupees 15,000. So we have a new reserve that came into the picture, and as we stated earlier already, when you have a new reserve, firstly we have to write off the old reserve, and then we have to write up the new reserve. So write off the old reserve first. So let's write off the old reserve. The old reserve is given in your liability side. So by reserve account, by reserve account, when it comes to the old reserve, this is only between A and B. C was not in the picture when this reserve came, right? So this is in the old ratio. So transfer rupees 10,000 in the ratio of 3:2 between A and B. It'll give you rupees 6,000 and rupees 4,000 respectively. Nothing for C. And then you have to write up a new reserve of rupees 15,000. So this reserve is to be shared equally amongst all of the three partners. So you write it down now. To reserve account, to reserve account, this is new profit sharing ratio. So new profit sharing ratio is equal. 15,000 will be divided equally. So each partner will be getting rupees 5,000. So divide that. 5,000 rupees, 5,000 for B and also for C. Rupees 5,000 each. Okay. So we have divided the reserve, and then provision for doubtful debts is to be created at the rate of 10% on total debtors. So you already have a provision in the question, right? In the old balance sheet, if you look at the old balance sheet, you have an amount for provision given as provision for doubtful debts, rupees 1,000. However, in the question, it was given provision for doubtful debts is to be created at 10% on total debtors. So we can create another working note for this. Let me write it as my second working note number 2. This is calculation of provision for doubtful debts. Calculation of provision for doubtful debts. Right. So as I stated earlier, in the question, debtors are given as rupees 20,000, right? So debtors in the old question is only for A and B. So debtors of A and B, debtors of A and B, as per the question, is equal to rupees 20,000. So provision for doubtful debts is at the rate of 10%. Therefore, provision is equal to new provision for the debts of A and B at the rate of 10% is equal to 20,000 into 10% is equal to rupees 2,000. And this 2,000 is the amount which should be shared between A and B. And then further, you have to create another provision in the question. If you see, we have already noted down how partner C has debtors, right? We've already noted down how partner C has debtors here. C, debtors account, partner C, 10,000. On these debtors also, we have to create a provision. So we have to write down the provision with regards to your new partner as well. And provision on C's debtors equal to his total debtors are rupees 10,000 and 10% provision gives us rupees 1,000. So you have two amounts for provision. The first amount for provision is this amount, which is to be shared between A and B, and the second amount for provision for doubtful debts is this 1,000 rupees, which is going to be exclusively only for partner C. Okay, so let's come back to the partner's capital account and let's write down the details with regards to provision for doubtful debts. Okay, so when it comes to provision for doubtful debts, let us record the entries to provision for doubtful debts to provision for doubtful debts account. And this is as per the recent working note that we made, working note number 2. And provision for doubtful debts, as we saw earlier, A and B is rupees 2,000. That is to be subdivided in the old ratio of 3:2. Okay. However, they already had an original provision in the old balance sheet of rupees 1,000, which means now that they only have to create a further provision of rupees 1,000. Okay, that means the provision for doubtful debts has to be increased in order to reach the actual amount of provision, rupees 2,000. So the provision that should be created for partners A and B is only up to the extent of rupees 1,000. Okay, I hope you understand. Let's do this once again. So provision for doubtful debts for A and B as per their total debts comes to 20,000 into 10%, rupees 2,000. However, in the original balance sheet, there is already a provision of rupees 1,000. So they only have to make up for the balance. So 2,000, which is the total of the new provision, minus rupees 1,000, which is the provision already existing, is equal to rupees 1,000. And this 1,000 should be shared between A and B in the ratio of 3:2. So we will have provision for A, rupees 600, provision for B, rupees 400, and as we've already seen, provision for C is going to be rupees 1,000. Okay, so that is provision for doubtful debts. And then finally, you have point number 5, an investment provision of rupees 2,000 is to be created. So search for investments in your old balance sheet. It's not there, right? The investments come into the picture only when it comes to your new partner, partner C. Okay, partner C brought in assets in the form of investments to the extent of rupees 12,000. So we only have to create a provision for investments under the account of partner C. So let's start with that. To investment provision account. To investment provision account. Only for partner C, amount given in the question, rupees 2,000. So jot down rupees 2,000. So now you've recorded all of your different assets and liabilities, even as per the adjustments also. However, they've given you under point number 2, the capitals of the partners should be equal taking C's capital as base. So now we have to close down our partner's capital account. So let's close our partner's capital accounts first. See what are the totals we are getting. So for partner A, the total we are getting, calculate. Okay, so let's calculate first for partner C. Why? Because we are going to be taking C's capital as base. So calculate the total for partner C. You should be getting it around, okay, credit side, rupees 58,000. Let me just zoom in. Okay, so for partner C, you've already calculated and it's coming to rupees 58,000. Let's balance this now. On the debit side, you have minus 5,000, minus 1,000, minus 2,000, and the final balance carried down is rupees 50,000. Okay, so by balance carried down in case of your partners, to balance carried down or to balance closing down is going to be rupees 50,000 for C. And as we have already seen, the capitals of the partner should be equal, taking C's capital as base. So whatever final balance that you have for C, that will also be the balance for your remaining partners. So C's final balance is rupees 50,000. Similarly, the balance for your partner B should also be 50,000, and for partner A is also rupees 50,000. Okay, so we've recorded as per all of the adjustments. Now close your accounts and see what is the balance you are getting. Okay, so let's close the account for partner A. For partner A, balance we are getting 55,600. For partner B, balance total I've gotten rupees 55,400, and for partner C we have already calculated, total is rupees 58,000. Okay, so any balance, any remaining amount that is calculated after taking the balances will be transferred to your bank account. So by bank account, my debit side is more. So by bank account, my balancing figure in case of A, 55,600 minus all of these, I'm going to be getting 14,600. Similarly for B also, my debit side is more. So 55,400 minus these totals, I'm going to be getting 21,400. When it comes to C, there is no bank account balancing figure. Okay, so this is our working note. So for partners capital account, we've got the opening balance, and then after that all of these additions that were brought in by your new partner, and then the reserve which was in the original balance sheet transferred, and then after that your new reserve which has been transferred equally, and then we created provisions also for our doubtful debts depending upon the adjustments that were given. This is based upon our old provision and adjustments with the old provision, and this rupees 1,000 is with regards to the debtors of partner C himself. And additionally, investment provision was also there, but investment provision only partner C had investments, so we only are giving the provision for partner C. And then we are calculating the balance by taking C's capital as balance or as common balance for all of your partners. So after seeing, we see on the credit side, partner C had 58,000, and then his balance is rupees 50,000, and 50,000 is now going to be the balance for your other partners, and then further adjustments were made and we calculated the balancing figure. So now we have to calculate your balance sheet. Okay, now we are going to do the actual solution, which is preparation of the balance sheet. So let us write down. So I've prepared my balance sheet of your new partners A, B, and C of your new firm as on 1st of January 2015. So you have your liabilities and you have your various assets. You write that down. So firstly, when we're opening up a balance sheet, we'll record on your liability side your various capital accounts. Okay, so let's record first your capital accounts. So capital first, and capital of A, capital of partner B, and capital of partner C. So as we have already seen from your partner's capital account, they all have equal partners. They all have equal balances, rupees 50,000 each. So I'm recording rupees 50,000 for every partner under liabilities partners accounts. Then the next liability we have are your reserves also. So let's record reserves. The old reserve was already written off, 10,000 rupees. We're going to now record your new reserve given rupees 15,000. And I'm also recording creditors, which is in your original balance sheet, and no changes were made to creditors, so rupees 25,000. Okay, this is my liability side. Now moving on to my asset side. Under the asset side, in the original balance sheet, you had land and building, plant and machinery. So let's write first land and building. Land and building given rupees 30,000, no changes were made, so rupees 30,000. And then plant and machinery, land and machinery, here also no changes were made, so I'm going to record it at the original value, rupees 20,000. And then you have stock. So for stock, the original stock as per the original balance sheet, it was rupees 10,000, but we had an addition in the form of the stock that was brought in by your new partner, which is rupees 21,000. So let's record that, rupees 21,000. That will give you rupees 31,000 in the outer column. Okay, and moving on, the next item that we have are your debtors. So write down debtors, and total debtors is rupees in your original balance sheet, rupees 20,000, and plus the debtors that were brought in by the new partner, rupees 10,000. So total debtors rupees 30,000. But you have some provisions for bad debts, so those provisions should be deducted. So less and write down provision for doubtful debts at the rate of 10%. Okay, write down provision for doubtful debts at the rate of 10%, and you can see it from your working note. Your working note number 1 or number 2, where we had calculated the provision for our doubtful debts, right? We had calculated the provision for doubtful debts, and we saw rupees 22,000 and rupees 1,000. So total provision is going to be rupees 3,000. So write down less provision for doubtful debts, rupees 3,000. Okay, so that will give you rupees 27,000. And after that, you also have new assets in the form of investments. So let's record our investment, which were brought in by the new partner. Investment total rupees 12,000. Less, again, in case of investments also we have provision, so less provision or investment provision, rupees 2,000. Balance to the outermost column, rupees 10,000. And then you have balances for bank and balances for cash. So for bank account, for bank, originally you had the opening balance rupees 11,000. Okay, you had the original balance of 11,000, and then when you were preparing your working note for capital account, you had given how bank account, this balancing figure here, bank account, you have 14,600 and 21,400, which is the amount brought in by your partners. Okay, so rupees 11,000 original balance plus amount brought in by partner A, 14,600, plus amount brought in by partner B, 21,400. The amounts that he brought in order to get a total balance or a total closing balance of rupees 50,000. Okay, so those values. So total of bank account rupees 47,000, and then you also have cash account. In case of cash account, you had an opening balance of rupees 10,000, and at the same time, your new partner, he also brought in cash worth rupees 15,000. So plus 15,000, total rupees 25,000. So we've recorded everything, including all the adjustments that were made. So get the total of your assets and liabilities side and see whether they tally or not. Okay, get the totals and see whether or not these two accounts tally.